Welcome to Your Life Simplified. My name is Brian Leitner, and I'll be the host of this podcast. Today's show is a bit different, and for those of you that have not listened in the past, we have something called Mariner Mail, where listeners of the show can email in their questions as it relates to their own financial plan or questions they may have, and we'll do our best to answer those questions, leveraging advisors we have and other experts on the team here at Mariner Wealth Advisors. So today, we're going to walk through a series of questions. And in order to help us answer those questions, I've invited Scott Voss, Jadin Winberg, employees here at Mariner Wealth Advisors to answer these questions. And the goal of the show is not only to answer the questions, but to be a resource for future questions that our listeners might have to help you make more informed financial decisions. So again, for those of you that have not listened to the show in the past and you're new to it or haven't emailed questions in, you can always feel comfortable to email questions to podcast@marinerwealthadvisors.com. So guys, thank you very much for joining the show today. I appreciate having you here. Before we get started, maybe just spend a minute introducing yourself and what you do here at Mariner Wealth Advisors. So Jadin, let's start with you.
Thank you, Brian. I'm Jadin Winberg. I lead Mariner's Trust and Estate Services. Two main things we do for Mariner is we provide corporate trustee services for our clients, as well as what I call estate advisory services. That can be anything from estate planning reviews to helping develop additional estate planning strategies for our clients. I've been with Mariner since inception of the trust company in 2013, and prior to coming to Mariner, I spent almost 10 years with a large bank trust company. I'm an attorney and also have a master's in tax law as my education background.
Thanks, Jade. Scott?
Thanks, Brian. I'm Scott Voss. I'm a CPA with 20 years of experience in tax. My team provides multiple services to Mariner clients and internally to wealth advisors as a resource for tax questions or issues that may come up. We also provide planning and tax preparation services to clients.
So taking a look at the questions here that we have in front of us, this first one's a tax question. So Scott, I'll start with you, but if anyone wants to chime in, whether it's this question or other questions, please feel free. So the first question is, we pay our 14-year-old daughter to do some chores around the house. Can we use these funds, or can she use these funds to contribute to an individual retirement account? Scott, you want to take that?
Well, the short answer to that is the IRS would strongly frown upon that, and the logic being that it's a related party relationship, and there's not really earned income per se that would be needed to make a contribution to either a Roth or a traditional IRA or any type of retirement account for that income. Now, conversely, if she's babysitting or mowing yards or doing something else for third parties and actually getting paid for that, keeping track of that information, and also to the extent a tax return would be required for that income, filing that with the earned income and reflecting in that way would be a vehicle that would allow for contributions to a traditional or Roth IRA.
So if I hear you correctly, the two biggest issues there are who is actually paying her and whether that's a related party, meaning relative or something of that nature. And the other is she actually reporting this on a tax return? And so checking those two boxes, it might be possible if that were the case.
Agreed.
Great. Thank you. The next question, we'll turn to Jadin because it's more of an estate planning question. And the question is, my attorney that created my estate plan has died. Is there something that I need to do? How do I get copies of that? And is it still in effect, if you will? Jadin?
So there's not necessarily an immediate need for action. As many people know with estate planning, typically you're not dealing with necessarily time-sensitive issues. Further, clients generally have copies of their estate planning documents that the attorney will provide to them at the completion of the drafting. In addition, they typically will give them the originals. Many attorneys do not like to hold on to originals. And so most of those documents should already be in a client's possession. If there is an immediate need for something, or you need to follow up with an estate planning attorney for some additional planning, things like that, if the deceased attorney was with a law firm, typically they have a succession plan in place for that attorney. And so it'd just be simply a matter of contacting that firm to find out which other attorney within their estate planning practice has taken over for that attorney's clients. And then from there, you just simply want to meet with that attorney, make sure it's a good fit, And if it's not, just like finding them from initially, you would just go out and try to find a new estate planning attorney to finish up any other work that you would need.
So that's excellent. What if they're not part of a law firm that has multiple attorneys? So in that example, obviously you can go see a different attorney, but what if it's just one individual, it's private practice? What do you do then if that person's no longer around?
So if it's a private practice situation, the first place you'd want to start is if they did have any staff, a secretary, maybe a paralegal, somebody else in their office that helped them with their work, you would want to contact them to find out if there was any sort of succession plan put in place that they're aware of. You also could check with that deceased attorney's trustees or executors of their estate plan to see if they did any sort of planning on the estate side and if the trustee executor can point them in the right direction. If all those options lead you to nowhere, what you would need to do is actually contact the State Bar Association where that attorney practiced and find out their procedures for having an inventory done on those files and forwarding those files to the appropriate clients. Each state has their own process for that.
So Jadin, based on the fact that a lot of attorneys do not retain the original copy of the estate planning documents, then I guess it's on the client to make sure that they're keeping this in a safe place. Where do you generally recommend they keep these documents?
So there's a couple different options. One, of course, is at Mariner, we have what's called the Mariner GPS system, and many of our clients will upload their important financial documents, including estate planning documents, to that system. If they don't choose to take advantage of that, what we typically recommend is a safe deposit box at a bank, preferably, because what you can do there when you do pass away, your trustees and executors actually have the option or the authority to do what's called a will check in your safe deposit box, and where the bank will allow those authorized individuals to come in and check that safety deposit box for those original estate planning documents.
Thanks, Jade. Appreciate that. So if someone's attorney does die, those documents are still in place. They've still been executed. So nothing changes from their overall estate plan that they've put in place. They just need to figure out who they're going to work with going forward as that person has changes within their own financial plan.
That's correct.
Hey, just a quick note to our listeners. If you have a topic that you want to hear on this podcast, or you have a question about your own personal financial situation, please don't hesitate. Go ahead and send us an email at podcast@marinerwealthadvisors.com, and we'll have an advisor reach out to you directly. And now back to the episode. So the next question is an estate tax question, and someone is asking, will they have to pay estate tax when they pass? Jay, why don't we start with you?
Sure. So estate tax is essentially, it's a tax on the value of the property that you own at your death. And this can include several things. Obviously, anything that you have in your individual name. Assets that you place into a revocable trust are part of that estate. Property which you have what's called incidents of ownership, and that's a kind of a term of art that I won't expand upon here, but that is included in your estate. Property in an irrevocable trust can be part of your estate if you're granted certain rights and retained powers under that trust document over that property. And it can also include property that you have given away within 3 years of your death. And so several things can comprise your estate. To your question of, will you have to pay taxes on that? It's a maybe you will. For most people, you will not have to. And I'm talking about federal estate tax here. Under the federal estate tax laws, there's actually an exclusion of up to $11,200,000 per individual of estate assets that are exempt from federal estate tax. So if your estate is less than that exclusion amount, you would not owe any federal estate tax. Obviously, if you're above that, how it works is any dollars above that estate exemption amount would be taxable at the federal estate tax rates. Further, there's also, it's a net estate tax or net estate that is taxed. And so there are certain deductions that you're allowed to offset your gross estate, such as charitable distributions, funeral administration expenses, certain creditor claims, and debts and mortgages. So those things can help decrease the value of your estate when you pass away.
So Jadin, thank you. I mean, with the exemption being so high, just over $11 million, you're right. Most Americans aren't going to be subject to this. But for those who will, it obviously can be impactful. And for those that are married, that 11 million plus exemption actually doubles. Is that correct?
That's correct. It actually doubles so that'd be 22.4 for married couples. And can be done simply through what's called a portability election. So you don't even need very much estate planning to take advantage of that exemption amount.
And something you said, you mentioned the difference between revocable, or you mentioned the words revocable versus irrevocable trust. Can you just spend maybe 30 seconds on explaining the difference? Because I know people get confused by that, especially if they're hearing it for the first time.
So revocable trust is exactly what it sounds like. It's a trust where you're granted the authority under that document to revoke it, make any changes, amend it, etc. And that's your typical, when we walk our clients through the estate planning process, that's going to be part of your basic estate plan is a revocable trust that you create during your lifetime. You own it, you pay the taxes on it, you can do what you want with those trust assets. Contrast that with an irrevocable trust, which again is like the name implies, it's a trust where you actually do not have the authority. Once you create that trust and place assets into that trust, you no longer have the authority to change the terms of that trust. Where it gets pulled into your estate, though, is those irrevocable trusts can grant you can retain certain rights and powers over those trust assets. One example would be a general power of appointment at your death, where you can direct where those trust assets go when you die. Those types of things can cause inclusion in your estate.
But in general, assets that are inside of an irrevocable trust will avoid that estate tax.
The assets themselves, potentially, right, if you don't have those certain powers that are also included.
So, Jadin, while this question wasn't necessarily asked, I'll ask it because it's a common question as it relates to estate tax and gifting. And so when someone gifts someone assets, whether it be stock or cash, is there tax associated with that, either by the person giving the gift or the person receiving that gift?
So how the estate tax laws work is the exclusion, so we'll call the $11,200,000 individual estate exclusion is actually a unified amount. And it's unified between what you own at your death and what you may give away during your lifetime. So you can do any combination of the two. For example, if you give away $1 million of your assets during your lifetime to your kids or grandkids, that when you pass away, the available exemption that you would have to offset any potential estate tax liability would be reduced by $1 million. Many of our higher net worth clients will do a combination of gifting during their lifetime and utilizing that exclusion at their death. So there would not necessarily be tax when you make that gift. It just reduces that amount that you would have available to offset estate taxes when you pass away.
That's great. Thank you. So the next question is as it relates to taxes. And this individual is saying that they've done their own taxes for years and they recently received a letter from the IRS, the Internal Revenue Service. What should I do first? Scott, I think you are the most qualified to answer that question.
Well, I think the first thing to do is something not to do, and that's panic. Most notices that come out from the IRS these days or from states are system generated, in that there's a piece of information that wasn't included with the filing. There's documentation issues. Most of the time it's not a we're going to come get you issue. So I think the first step would be to compare what the notice says versus what the data that you've accumulated is, and make sure that the IRS or the tax authority is in line with what should be filed and responding accordingly. The other piece I'd say is if it falls into that kind of simple fix, responding back to them and letting them know if you agree with it, if you disagree with it, why, going from there. If it's a more in-depth issue that requires further analysis, I'd suggest working through your wealth advisor to get to a CPA practices in that area and get responding back and staying in touch with the IRS for communication purposes is key.
Thanks, Scott. And from what I've seen, it's in that situation, it's key to keep a paper trail of the person you're talking to, whether they be a field agent or whoever at the IRS, and making sure that you have copies of everything as it relates to your tax return so you can produce that when asked upon to do so.
Absolutely.
So guys, those are the questions that we were going over. But while I have you here, I thought I'd just ask you guys maybe just one question, maybe a lightning round, if you will, and just ask each of you. Over the past few weeks, what's a mistake that you've seen people making? It could be something that relates to your area or your specific area, or something else you've seen, you've heard about, and you'd like to just share that knowledge with our listeners today.
From an estate planning perspective, the biggest mistake that I usually see are estate plan documents that are inadequate, outdated, or poorly drafted. Inadequate documents are, an example of that would be a client with a very substantial estate or a complex composition of estate assets, closely held business interests, things of that nature, and their estate planning just doesn't adequately address those issues and concerns within their estate. An outdated estate plan would be something where, for instance, a trustee that you have named as a successor is somebody that you no longer have a good relationship, that your spouse may not get along with if they were the ones who were to survive, or your children, and have to work with that trustee. And then poorly drafted is simply estate documents that usually are done maybe by an attorney who is not well versed in estate planning, and that's usually very apparent with the document, or they've attempted to do several amendments to a document to the point where it's the whole thing is very convoluted and hard to follow. And so what we typically would recommend in something like that is just going ahead and restating the whole thing from scratch.
Jadin, those are great points. Just something as simple as, I had my estate plan done, I spent money doing this, but you know what, after it was done, I sort of put it on the shelf. I didn't keep it updated. And the reality is that life changes, tax laws change, and that individual says, we met with the attorney, we should be good. And they don't think about really what's changed in their life since those documents have been done. So that's a great point.
That's exactly right.
So Jadin, as I just mentioned, things happen in someone's life and so forth. Having these updated are important. How often should someone update their estate plan?
So the rule I like to go by is what I call the 3 Ps, and it's people, property, or plan. And so that's a change to any of those situations. People would be births, deaths, marriages, divorces, things like that. Property would be if your wealth has grown substantially, maybe your business has really taken off, or you've had a big liquidation event, or you've inherited a lot of money. And then plan would just simply be if your values and objectives with your assets has changed. For instance, you maybe were going to leave money to a niece and nephew, and you no longer would wish to do that, and you'd want it to go to charity or something along those lines. Those types of things usually always warrant a review and often an update of your estate plan. And then every 3 to 5 years, it's a good idea to just pull those out and take another look at those documents.
Thanks, Jade. Scott?
I'd say the biggest mistake I see clients coming up with is really a lack of communication. When I say that, 2 things immediately leap to mind. A lot of tax planning goes on between a wealth advisor and a client. And sometimes that information doesn't make its way to the person who's putting the numbers into boxes and completing the income tax return. And 2 specific incidents of that I've seen is folks making contributions to a donor advised fund with appreciated assets, and those assets not making their way onto the Schedule A because nobody tells the CPA. The other item that's out there that I think is going to get more traction with the increase to the standard deduction is taking your RMD and making a qualified charitable distribution directly to the charity. And instead of getting a deduction on your Schedule A, it's a reduction to your taxable distribution on the IRA, which is a good thing. You get to a net the same answer, but if you're taking the standard deduction at $24,000, you may not have been exceeding that number with your itemized deductions. It's critical that get communicated to the CPA because the tax forms that come out don't indicate that a qualified charitable distribution is being made from the RMD of the IRA.
It's great points. Communication is like everything, is absolutely critical as it relates to whether it be your financial plan or anything else. So thanks, Scott. I want to just thank you guys for being here. I really appreciate your time and expertise. And I'm sure our listeners will certainly benefit from this conversation. So thanks again. So that wraps up another show. Again, if you guys have questions about your own personal financial situation and would love to have answers to those, go ahead and email us at Mariner Mail. And that address is podcast@marinerwealthadvisors.com. And don't forget to subscribe to us wherever you listen to your podcast. And please feel free to go ahead and rate the show because that helps the show. We know that your time is incredibly valuable, and we hope you find this podcast a worthwhile investment of your time. Thank you for listening.
Mariner LLC LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC registered investment advisor. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money.